Most traders spend years looking for something new, a new indicator, a new strategy, a new mentor, a new session, a new pair, a new secret. They believe improvement comes from addition, more knowledge, more tools, more complexity. But real improvement in trading comes from one subtraction, one decision, one act of discipline that restructures everything you do in the market. That decision is this: you stop reacting to price and you commit to operating from a single, repeatable framework. Not 10 frameworks, not a mix of styles, not intuition one day and rules the next. One framework, one lens through which all price is interpreted. Until you do this, improvement will always be temporary. Most traders do not realize that inconsistency is not caused by the market. It is caused by the trader switching identities inside the same account. One moment you are a trend trader. The next moment you are fading highs. Then you are scalping. Then you are holding. Then you are hoping. Price did not change who you are. Emotion did. The market rewards identity clarity. When you decide who you are as a trader and you enforce that identity, everything begins to slow down. Noise fades. Urgency disappears. Decision-making becomes calm. The reason this single decision improves your trading is because it attacks the root problem, not the symptom. The root problem is not entries. It is not stops. It is not psychology in isolation. It is lack of commitment to a process. A trader without a fixed process is always vulnerable. Vulnerable to FOMO, vulnerable to social media, vulnerable to random wins reinforcing bad habits, vulnerable to random losses destroying confidence. Every candle becomes a negotiation. Every move becomes a temptation. When you decide once and for all that you will only operate from a defined framework, you remove negotiation from the chart. The market no longer asks you what you feel. It asks only one question: does this align or not? This is where improvement begins. Most traders say they have a strategy. Very few traders have a non-negotiable operating model. A real model dictates when you are active, when you are passive, when you are aggressive, and when you are completely absent. It defines what you ignore just as much as what you trade. The moment you make this decision, you will feel uncomfortable. Your brain will tell you that you are missing opportunities, that you are being too strict, that flexibility is strength. This is a lie. Flexibility without mastery is chaos. Discipline feels restrictive only to an undisciplined mind. Every professional trader you study, whether they say it openly or not, made this decision early or learned it painfully later. They stopped trying to trade everything. They stopped trying to be right all the time. They stopped trying to prove intelligence to the market. They chose one way to see price and they refined it relentlessly. This decision forces you to confront your real enemy, yourself. Not the market, not manipulation, not institutions. Your inability to wait, your need to participate, your fear of being left behind. Once you commit to one framework, you are forced to sit through discomfort. You watch price move without you. You see moves that would have paid. You feel regret. And then something interesting happens. You survive it. Nothing breaks. Your account is safe. Your identity remains intact. This is how emotional strength is built. Improvement in trading does not come from catching more trades. It comes from needing fewer trades to grow. That only happens when your framework filters aggressively, when it says no far more than it says yes. At this stage, many traders sabotage themselves by tweaking the framework too early. They see one loss and adjust, one win and expand. This resets the learning curve every time. Improvement requires stillness, the same setup, the same execution, the same risk, over and over. You are not trying to prove the framework works in 1 week. You are trying to align your nervous system to operate within it. This is why this single decision is so powerful. It restructures time. You stop thinking in days and start thinking in samples. 20 trades, 50 trades, 100 trades. You begin to understand probability emotionally, not just intellectually. another transformation occurs. You stop asking the market for permission. You stop staring at price, hoping it will do something. You wait for your conditions. The market either delivers or it does not. Either outcome is acceptable. This is where confidence is born, not from wins, but from self-trust. Most traders think confidence comes after consistency. In reality, consistency comes after commitment. Commitment to one process, one way of seeing price, one set of rules that does not bend under pressure. When you make this decision, your losses begin to change character. They are no longer confusing. They no longer feel personal. You know why they happened. You expected them as part of distribution. This alone reduces emotional damage by more than half. Your wins also change. They do not create euphoria. They confirm alignment. You do not feel smart. You feel disciplined. This is a critical shift. Emotional neutrality is not boredom. It is maturity. The market does not reward excitement. It rewards precision. This chapter is not telling you what framework to choose. That comes later. This chapter is about the act of choosing and committing. Most traders delay this moment forever. They say they are still learning, still exploring, still gathering information. Years pass. Improvement waits on the other side of decision. The moment you decide, your screen time changes. You are no longer watching every tick. You are waiting for context. You are studying behavior around key areas. You are observing how price respects or violates your model. Your journal changes too. You stop writing emotional summaries and start documenting execution quality. Did you follow rules? Did you wait? Did you enter where you said you would? This is trading like a professional. Not because you have money, but because you have structure. If you do this once, truly once, without retreating, your trading will improve. Not immediately in profit, but immediately in clarity. And clarity always precedes profitability. Most people will not do this. They will continue to oscillate between hope and frustration, between overconfidence and self-doubt, between strategy hopping and emotional exhaustion. But if you are willing to endure the discomfort of commitment, the market begins to reveal its rhythm to you. Not because it changed, but because you did. This is the foundation. Without it, nothing else matters. With it, everything else becomes possible. Once you have made the decision to operate from a single framework, the next step is not to add refinement. It is to remove one destructive behavior that silently sabotages most traders. Decision-making outside of predefined time and context. This is where many traders fail without realizing it. They believe they are following a system, but in reality, they are making decisions at random moments, in random conditions, driven by emotional pressure rather than structure. Improvement accelerates when you remove the habit of engaging the market whenever price moves. The market is not meant to be traded at all times. Price is active constantly, but opportunity is not. The inability to separate activity from opportunity is one of the deepest causes of inconsistency. When you trade outside of defined time windows and contextual bias, you invite noise into your decision making. Noise creates confusion. Confusion creates hesitation. Hesitation creates impulsive execution, and impulsive execution destroys trust. Professional traders do not ask, is price moving? They ask, is price moving in the environment where my edge exists? That environment is defined by time, structure, and narrative. The moment you remove random engagement, something changes psychologically. You stop feeling pressured to act. You stop interpreting every candle as a signal. The chart becomes quieter, even though price is still moving. This quietness is not market-based. It is mental. Most retail traders trade too often because they are uncomfortable with stillness. Silence feels like missing out. Doing nothing feels like falling behind. But stillness is where clarity forms. When you define when you trade, you automatically define when you do not trade. This creates boundaries. Boundaries protect discipline. Without boundaries, emotion governs behavior. Time-based discipline is not arbitrary. Markets have phases of expansion and contraction. Liquidity enters at specific windows. Institutional participation is not evenly distributed across the day. When you ignore this reality, you trade against flow without realizing it. By committing to specific sessions or time blocks, you align with repetition. Repetition creates familiarity. Familiarity reduces fear. Fear reduction improves execution. This is why removing random trading improves results without changing strategy. Another layer to remove is reactive analysis. Many traders analyze after price moves. They see displacement, then scramble to justify an entry. They see a breakout, then rush to frame it as valid. This backward logic is driven by FOMO, not structure. True clarity comes from anticipation, not reaction. Anticipation is only possible when context is defined ahead of time. You know where price must go to validate your bias. You know what invalidates it. Everything else is irrelevant. Removing reactive analysis forces patience. Patience is uncomfortable because it confronts ego. Ego wants to be involved. Ego wants to be seen as active and intelligent. The market does not care about ego. It rewards alignment. Most traders mistake analysis for activity. They redraw levels constantly. They change bias candle by candle. They confuse movement with progress. This mental churn creates exhaustion and inconsistency. When you remove this behavior, your chart becomes stable. Levels remain. Bias remains. You are not trying to outthink the market. You are waiting for it to deliver. Another destructive habit to remove is over-monitoring trades. Once in a position, many traders stare at price tick by tick. Every pullback feels like a threat. Every pause feels like failure. This leads to premature exits and emotional decision-making. By removing constant monitoring, you allow trades to express their probability. You accept variance. You stop trying to control outcome and focus on execution. Clarity grows when you accept that once a trade is placed according to plan, your job is done. Managing emotion is not about controlling price. It is about controlling attention. Attention directed at randomness increases stress. Attention directed at process increases calm. Another critical removal is external validation. Social media, chat rooms, signals, and opinions dilute clarity. When you consume too many perspectives, your internal compass weakens. You hesitate, you second guess, you override rules. Improvement requires internal authority. That authority comes from repetition within one framework, not consensus. The trader who needs confirmation from others will always be late. The trader who trusts their model can act decisively. When you remove outside noise, you begin to hear your own decision-making process clearly. You can identify mistakes faster. You can correct them without defensiveness. This chapter is not about becoming rigid. It is about becoming precise. Precision requires boundaries. Boundaries require removal. Most traders ask what they should add to improve. Very few ask what they must stop doing. Improvement accelerates when subtraction precedes addition. Once these behaviors are removed, something subtle but powerful happens. Your emotional swings reduce. Your losses hurt less. Your wins feel calmer. Your execution becomes repeatable. You begin to notice that many losing days were not caused by bad market conditions, but by breaking boundaries, trading at the wrong time, trading without context, trading out of boredom or frustration. This awareness alone improves performance. By now, your trading day looks different. You prepare before the session, you mark levels, you define bias, and then you wait. If nothing aligns, you do nothing, and you feel okay about it. That is progress. The market no longer controls your emotions. Your structure does. Once you have committed to a single framework and removed the behaviors that create noise and confusion, the next phase of improvement is execution. This is where most traders believe they are strong, but in reality, execution is where discipline is either proven or exposed. Execution is not about entries alone. It is about how you behave before, during, and after the trade. One execution habit done consistently has the power to compound everything you have already fixed. You execute only at predefined prices, never at moving price. This sounds simple, almost obvious, but this is where the majority of traders fail. They wait patiently, they have bias, they have levels, and then when price approaches, emotion takes over. They chase, they anticipate early, they click because price might not come back. That single moment is where discipline breaks. When you decide that you will only execute at specific prices that you marked before the session, you eliminate impulsive behavior. You are no longer negotiating with the market in real time. The decision was made earlier in a calm state. This is how professionals trade. They decide when they are emotionally neutral. They act when conditions are met. They do not improvise under pressure. Most FOMO-driven losses come from executing at moving price, chasing a candle, entering mid-range, clicking because of urgency. This destroys risk to reward and increases emotional attachment. By executing only at predefined prices, you align risk with logic. Stops are placed where structure invalidates. Targets are placed where opposing liquidity exists. Nothing is arbitrary. This habit alone dramatically improves performance, even with the same win rate. Another critical component of execution is fixed risk per trade, not flexible, not adjusted emotionally, fixed. When risk fluctuates, psychology fluctuates. When risk is stable, the mind stays calm. Fixed risk transforms losses. They become expected and manageable. There is no panic, no revenge, no need to recover immediately. Execution discipline also includes accepting missed entries without chasing. If price does not reach your level, the trade does not exist. This is not discipline as punishment, it is discipline as protection. Many traders believe that being flexible increases opportunity. In reality, flexibility without rules increases error. Missed trades are not lost money. Chased trades are. This is where compounding begins. Every time you do not chase, you preserve capital. Every time you execute precisely, you reinforce trust. Every time you accept a missed trade calmly, you strengthen emotional control. Another execution habit that compounds improvement is one trade idea at a time. Most traders sabotage themselves by stacking ideas. They hold a bias, then flip, then re-enter, then hedge mentally. This creates confusion and emotional exhaustion. Professional execution is clean. One idea, one invalidation. If invalidated, you step aside. No emotional attachment. This simplicity improves clarity and reduces overtrading. Execution also includes ending the trading day intentionally. Most traders stop trading when they're emotionally depleted or financially damaged. Professionals stop based on rules. One loss, one win, time-based cutoff. Whatever the rule, it is defined beforehand. Ending the day intentionally prevents emotional spirals. It preserves mental capital, which is more important than financial capital in the long run. Another overlooked execution habit is post-trade neutrality. After a trade, win or loss, you return to neutral. No celebration, no frustration. Emotional spikes create bias for the next decision. Neutrality keeps execution consistent. By this point, trading begins to feel less exciting. That is a good sign. Excitement is volatility in the nervous system. Consistency requires calm. You begin to notice something important. Your best days are not days with many trades. They are days with one clean execution or no trade at all. You start to respect restraint as skill. Execution is where confidence becomes real. Not confidence in prediction, but confidence in behavior. You trust yourself to do what you said you would do. This trust compounds faster than any strategy. Losses no longer trigger self-doubt. Wins no longer inflate ego. You are no longer trying to prove anything to the market. You are simply executing. This is the point where many traders finally feel like professionals, regardless of account size. By the time you reach this stage, your trading has already changed. Not because you found a perfect setup, but because you altered how you interact with the market. Now we address the final and most important action. This is the step that locks everything in and makes improvement permanent rather than temporary. The one thing you must do is this: conduct a full behavioral audit of yourself as a trader and never stop updating it. Most traders review charts, very few review themselves. A behavioral audit is not about profit and loss. It is about identity, habits, and consistency of action. It forces you to confront whether you are actually trading the way you claim to trade. Without this step, all improvement fades, discipline erodes, old habits return, emotion slowly re enters decision making. The market did not change. You drifted. The reason improvement disappears for most traders is not lack of knowledge. It is lack of self-observation. When you document behavior honestly, patterns emerge. You see where rules are bent. You see which emotions precede mistakes. You see which environments produce clarity and which create chaos. This awareness creates accountability. Accountability changes behavior. Your audit should answer only a few core questions after each session or week. Did I follow my framework exactly? Did I trade only at predefined prices? Did I respect time and context? Did I accept missed trades without chasing? Did I manage risk consistently? Did I stop trading according to plan? Notice what is missing. There is no question about whether you made money. Money is a byproduct. Behavior is the driver. When improvement is tied to money, discipline collapses during drawdown. When improvement is tied to behavior, discipline strengthens under pressure. This is how professional traders survive long term. Another component of permanence is detaching identity from outcome. You are not your last trade. You are not your equity curve. You are the operator of a process. When identity is tied to outcome, emotions control decisions. When identity is tied to process, outcomes take care of themselves. The audit reinforces this separation. You begin to view mistakes neutrally, not as failure, but as data. This removes shame and defensiveness. It allows correction without emotional weight. Permanent improvement also requires periodic constraint. Even advanced traders fall into overconfidence. They loosen rules, they trade more, they push size. Constraint resets discipline. This may mean reducing size intentionally, limiting trades per day, or trading only one setup for a period of time. Constraint sharpens execution and humility. Another overlooked element is protecting mental capital. Burnout leads to emotional trading. Emotional trading leads to losses. Losses reinforce fear and impulsivity. You protect mental capital by having defined off-market time. No charts, no opinions, no performance obsession. This rest is not laziness. It is maintenance. Permanent improvement also comes from accepting boredom. Boredom is the price of consistency. The market does not reward entertainment. It rewards patience. If trading feels exciting every day, you are likely overtrading. At this level, you begin to understand that the market does not need you. You need the market to align with your framework. This shift removes desperation. You no longer feel chased by price. You feel selective. The final mindset shift is understanding that your job is not to make money. Your job is to execute well. Money is the scoreboard, not the task. When you do this once, commit to a framework, remove noise, execute only at defined prices, and audit behavior relentlessly, your trading improves structurally. Even if you step away and return, the foundation remains. This is not motivation. This is architecture. Most traders want a breakthrough moment. Trading does not reward breakthroughs. It rewards quiet repetition. By now, you should see that improvement is not mysterious. It is not hidden. It is not reserved for the gifted. It is available to anyone willing to be honest, disciplined, and patient. Do this once, truly once, without retreat, without excuses, and your trading will never be the same again.